Adam Sweet, and I am principal with Eide National Tax Office. I sit in Spokane, but I'm kind of a resource to the whole firm. And my focus is pass-through entities, partnerships, and S corporations. And with tax reform, really, I've been spending a lot of time with new Section 199A, which we're going to get into today. But interestingly enough, in the 199A, you might think of it as being a domestic provision that affects mainly domestic businesses. There are lots of considerations as well for businesses that are doing business here in the States, and perhaps also businesses with outbound considerations. So I'm joined with my fellow co-panelist is Aaron Boyer. Aaron, I'll let you introduce yourself.
Sure. Well, thanks, Adam. Really excited to be here. As Adam mentioned, my name is Aaron Boyer. I'm manager in Eide Bailey's National Tax Office. I specialize in international tax. Within Eide Bailey's International Tax Group, we kind of run the gamut as far as different types of transactions, different taxpayers we assist. We help with individual taxation, with corporate taxation, flow-through taxation when there's foreign activity. And as part of tax reform, of course, our lives in international tax have been significantly changed. And one item is related to 199A. And specifically, how does that affect foreign persons that have U.S. activity? Are they eligible for 199A? And U.S. businesses, trades or businesses that have activity outside the U.S., does that qualify for 199A? So I work quite a bit with structuring, with planning for how to minimize tax when you have expansions into foreign jurisdictions. And part of that role or that goal is, if we can minimize tax, how can we use something like 199A to do so? And so it's something that we've come across quite often, especially in the structuring world, and excited to see how the two kind of match up as we go through the slides.
Thanks, Aaron. So just a quick agenda here that I think we'll start with some background just on Section 199A, the mechanics of 199A, the purpose of 199A, how it works, and the various limitations. And then Aaron can layer in the international aspects to this. So first of all, how the sourcing rules interact with the new Section 199A deduction, and then also how the inbound and outbound considerations. But again, we'll start with just an introduction to 199A to try to lay the groundwork. So it's the 199A, it's a deduction. It provides a 20% deduction with respect to qualified business income, QBI. So the first important point is that not all income is necessarily qualified business income. And particularly to the international space, one of the definitions of qualified business income is that it has to be effectively connected income, ECI, so effectively connected with the US trade or business. The purpose, if people wonder what is the purpose of 199A, why did Congress enact it? The purpose was to equalize treatment of pass-through businesses with C corporations. C corporations pay an entity level tax. Their rate was dropped with tax reform. Their rate was dropped from a high of 35%. It was a graduated rate structure, but the top rate was 35%. It is now a flat 21% rate paid by C corporations. Problem is that most businesses in America are not C corporations. You know, the large companies are, your publicly traded companies are C corporations, but most businesses, and really probably 90% of our clients, Eide Bailey's clients, are not C corporations. They're what we call pass-through entities, and meaning that the owners pay the tax of the business. The business flows through its income, and then the owners pay the tax on their own return. They don't benefit from the C corporate rate drop doesn't benefit them because they pay tax at individual rates. So 199A was passed really to equalize that. If you had qualified business income and it flows through, you're an owner of a pass-through entity and it flows through, you get this deduction and it drops your rate. The highest applicable federal rate for individuals is 37%. If you get the 199A deduction, it can drop your rate down to 29.6%. So it's ultimately, as the bullet point here, it's determined at the individual level. We're not going to get into it too much today, the mechanics, but just know that even if you have QBI, there's many other factors that can go into whether you will have the full deduction. There's a limitation related to wages paid as part of the business. There's also a limitation related to the tax basis of property used in the trade or business. So we won't get into it today, but just remember that it's not, just having QBI is not necessarily the end of the story. So the first, when Aaron and I were discussing this over the last couple of months and thinking about what were some of the international ramifications, I think the one area that we thought about right away was real estate. And so I'll set the background first for what 199A says about real estate, its treatment of real estate and specifically rental income, and then Aaron can layer in some of the international components to it. But first, rental income can be QBI, can be qualified business income. It's not necessarily always qualified business income. And the problem is that there's some very messy case law and guidance out there from the IRS where taxpayers have been fighting with the IRS for over the last 60 to 70 years about whether a real estate activity rises to the level of a trade or business or not. If it rises to the level of a trade or business, for 199A purposes, the rental income can be qualified business income. If it doesn't rise to the level of a trade or business, it's not QBI. So if your question back to me is, well, how do I know if my rental activity or my real estate activity rises to the level of trade or business? Unfortunately, the answer is no one quite knows. It's hard to put your finger exactly on the spot to say, here are the 10 factors, or here are the 10 exclusive factors or elements to look at. And I contrast that with other businesses, non-real estate businesses. If you think about manufacturing, if you had a global manufacturing company or sales company, lots of other businesses, we know it. I use the phrase "know it when you see it." They have operating income. We're going to be able to just say that's QBI. Clearly, that's trade or business. But we don't have that same presumption or that same know it when you see it to rental income, unfortunately. And the reason is not unique to tax reform. It's just this has been a fought over area since really the first Internal Revenue Code in 1954. But really, so what the IRS has said is that if you have a real estate activity, if you own a commercial office building, or you own a bunch of homes, or you own a condominium association, whether it's a trade or business or not, it comes down to what's called a facts and circumstances analysis, a subjective analysis. And some of the things that the IRS says matter are scale. So how large? Scale is it one building versus 10 buildings? Time, how much time do owners or employees or contractors spend in the activity? Commercial versus residential. I think sometimes people think that commercial real estate looks more like a trade or business versus residential. If you're just an Eide Bailey partner like myself and own a single rental home, maybe that doesn't look like a trade or business. Books and records. The more formal your books and records you have and maintain, it looks more like a trade or business, and many other factors that you could Google or reach out to us afterwards. But all these factors will go into this facts and circumstances analysis. Another key point is the Section 469 passive activity rules. These are a set of rules that are designed to limit if you're an owner of an entity and you don't participate in the business, it limits your use of losses from that business. Those rules are not relevant for 199A. So if in the back of your mind, if you're thinking, well, I'm a real estate professional or I materially participate in the business, that's not really relevant for 199A. The 199A is a standalone provision and really divorced from the passive activity rules. So the IRS has two, they put out proposed regulations last fall and they put out final regulations this spring. And there was lots of commentary when the proposed regulations were issued last fall. There was lots of commentary saying, IRS, you need to give us more guidance on rental income. There's broad swaths of America get K-1s with rental income on it from a real estate activity. The IRS can't just say, well, it's facts and circumstances, go talk with your tax advisor. Give us some rules that we can operate under. And the proposed regulations that came out, and then also the final regulations that came out in the spring, do give us some clarity to certain situations. The final regulations told us in the spring they gave a proposed safe harbor, and the proposed safe harbor was in the form of a proposed revenue procedure. And what it said was, if you have a rental real estate enterprise, which is a defined term, the IRS will deem that to be a trade or business if you meet certain requirements. And we have it on the slides here, but I'll try to highlight the big points here. One, you can't put, for the IRS's purposes, if you have a mix of commercial and residential, that cannot be treated as one business. And two, that if you have pure commercial or pure residential, that there are generally 3 requirements for meeting the safe harbor. The first requirement is that you need 250 hours of qualifying service during the year. Now, a couple of things to note here, that doesn't have to be owner's time, so that you could be just sitting collecting a K-1 in another country or down in Arizona, and you don't have to spend any time in the business, because employees' time counts, independent contractors' time counts. If you're paying a property management company to perform services, that time counts. That can all go into the bucket here for determining if you have 250 hours. But the other important point is that not all time necessarily qualifies. The IRS focused on what it deems services performed as part of a trade or business, which is that first sub-bullet point, maintenance, repairs, etc. The IRS said non-qualifying services, that in the IRS's mind looks more like as part of an investor's role, like arranging financing or reviewing financial statements. That type of time doesn't qualify. Along with this, you need to keep contemporaneous records to demonstrate the 250 hours. So some type of calendar or log to demonstrate that. The second requirement, and again, this is the safe harbor for treating rental income as QBI, is that you need separate books and records. And so what are books and records? Who knows? The more formal, the better probably, but no doubt there may be some people that just have Excel spreadsheets that are tracking income and expenses, and under certain circumstances, maybe that even counts as books and records. But something there, some separate ledger or books or Excel spreadsheets or something there where someone is tracking the activity of the business. In the IRS's mind, that looks more like a trade or business, so that meets the second requirement. And then the third requirement, and this is probably the most problematic for many people, is that if you have a triple net lease, you cannot meet the safe harbor. And triple net lease in the IRS's mind is when the tenant is responsible for all or a portion of the taxes, fees, and insurance and maintenance. It's problematic because in the US commercial real estate market right now, triple net leases are probably the predominant form of lease. It's industry norm. Both tenants and landlords are familiar with it. The lease terms are set based upon that. So it's problematic because just by looking at the definitions of the safe harbor, the majority of at least commercial activity in the US, commercial real estate activity, won't qualify under this safe harbor. So what happens so I just outlined quickly those 3 different factors, and maybe you're thinking, I don't meet one of those factors, this must mean something bad. Not at all. The safe harbor is just something that the IRS invented out of whole cloth to provide some guidance. But just because you don't meet the safe harbor doesn't mean anything. It doesn't mean that your rental income can't be QBI and that you can't get the 199A deduction. But I think it does provide some useful factors to consider. Even if you don't meet all of the 3 safe harbor requirements, it does show that the IRS thinks if you have books and records, it's important. You need some time involved in the activity. And again, it doesn't have to be owner time. It can be employee time, third-party contractors, etc. Also, it's important to make it look like a business. So to the extent that you're paying third parties or contractors, you should be filing Forms 1099 with the IRS reflecting that payment. And triple net leases, the IRS may focus on that if you are claiming 199A and the rental income is generated from a triple net lease. Maybe there's some extra scrutiny there, but I also think, and we also think, that if there's scale involved, that may be able to overcome the bad fact of a triple net lease. In other words, if you have 20 commercial office buildings, even if they're on triple net lease, it would seem to be very difficult for the IRS to tell you that you don't have a trader business. But versus one residential home on a triple net lease, maybe that does look like an investment activity and not a trader business. The other important rule to remember, and this is probably the rule that the majority of our clients have relied upon, is there's a self-rental rule under 199A. And self-rental is where you have an operations, and then the real estate used by the operations is housed in a separate legal entity. You do this for asset protection purposes, for state law purposes, maybe even for tax planning purposes. There could be domestic tax planning or even international tax considerations for why you would do this. Very, very common. And the IRS said, if the real estate's used by the operations and you have common ownership between these two, the rental income is automatically deemed to be trader business income related to the operations. So you don't have to worry about the real estate safe harbor. You don't have to worry about all the murky case law. You don't have to worry about arguing facts and circumstances with the IRS. They're going to draw a big circle around that whole thing and just say that's one trader business. And the reason why they did that is otherwise, if they didn't do that, it's too easy to manipulate either the left or the right side of the equation. You could either, if it's to your advantage, you could increase rents and pay rents over to the left side to the real estate entity, or you could understate rents and increase income of the operating company. And so instead, the IRS has said, no, we're just going to draw a big circle around the whole thing and say that's just one trader business. So this is also a very helpful rule. If you have real estate used as part of a trader business and you have common ownership, you can just completely bypass the safe harbor, completely bypass all of the other criteria that I just talked about. Turn it over to Aaron, maybe to layer in some international tax considerations.
Sure, absolutely. Well, thanks, Adam. So one structure that we see fairly common, or one transaction that's fairly common within Eide Bailly and our client base, is related to foreign persons owning U.S. real estate. And there's a variety of factors that contribute to the decision-making of how to best structure that. And from an income tax perspective, typically it's most efficient if those foreign persons own the U.S. Real property directly. Mainly because if they pay, when they pay tax here in the U.S., that's typically creditable in their foreign jurisdiction. And depending on the rate in their foreign country, they may not really care how much tax they're paying in the U.S. For instance, if they're located in a foreign jurisdiction where their effective tax rate is 50%, well, if they pay 37% tax in the U.S. and they're able to credit 100% of that in their foreign jurisdiction, then whether they pay 37%, 40%, even 49%, they probably don't care. On the other hand, if their effective tax rate in the foreign country is less than the applicable US tax rate, for instance, let's say 20%, then it really does matter to them what tax rate they're paying here in the US. And thus, something like 199A can be of something that's of interest to them. And I want to mention, just for completeness, that income tax, at least for a foreign individual with US real property, income tax may not be the only consideration, and commonly it's not. A foreign person that owns US assets, if they were to pass away, that may create a taxable US estate. Unlike US citizens and US residents, the exemption for a foreign person's US estate is typically $60,000. That's very low. And so if the value of their real estate's over and above that, that would be subject to typically 40% estate tax. And so estate tax is a big big factor in the decision-making process. Same thing with gifts. If there's US real property, making a gift of that US real property could trigger gift tax, again at around 40%. And so there are other factors that an individual would consider, but strictly from an income tax perspective, owning real estate directly typically is the way to go, and we commonly see that. So a foreign person is typically taxed in the US on their US real estate income one of two ways. And one, they either treat the rental income, they subject it to an FDAP regime, and their gross rents are subject to a flat 30% tax. So ignore deductions, and you say if you had $100,000 of gross rents, then that income is subject to a flat 30% tax, or $30,000. Typically not very favorable, right? Because in real estate, you'll generally have several types of deductions: depreciation, interest, real estate taxes, maybe you're paying an agent, etc. And so those can be beneficial, and especially if you have royalties from mineral rights, you may get depletion in that case. So there's an alternate regime or an alternative regime, and that's the income could be taxed under ECI, effectively connected income. That income is subject to graduated US tax rates on the net. So if you take that same example of 100,000, if there were deductions that were applicable to that income, then you would arrive at net income and you would subject that net income to graduated tax rates, the brackets that we use as US citizens. And so why does that really matter, I guess, for 199A? And it's interesting, Adam, as you've been talking through some of the considerations and kind of the headache of, well, we've never really had clear guidance on what a trade or business is for rental property. And that's certainly been the case for foreign persons owning US real estate, because we have these two regimes. And so we had to choose, well, is it FDAP or is it ECI? And really the only way you could get to ECI is if you had a trade or business and you had that income that was effectively connected with US trade or business. And so for real estate in the US, we'd either go through an analysis and determine whether is that income eligible for these graduated rates and to be taxed on a net basis, or do we have to use this FDAP regime? And with real estate, you could elect. So if you went through that analysis and you said, well, I don't really know, or you just wanted to bypass that analysis, the foreign person could just make an election under 871D and elect to treat that US real property income as if it was effectively connected with a US trade or business, and so you'd get a very favorable result. It's interesting that under 199A, under the proposed regulations, it was, at least in the preamble, it was pretty clear, and it was also mentioned in the preamble to the final regulations, that to have income that's eligible for 199A, it needed to be ECI, effectively connected with the US trade or business. And that if you had a foreign person that made an election under 871D to treat that income as if it were effectively connected income with the US trade or business, that typically was not enough. That was insufficient to be eligible for 199A. And so what that could mean is that you may see a tax return, or you may be someone, a foreign person that owns US real property, and on your tax return, it's showing up as income that's taxed on a net basis. And normally you think, well, then that's ECI, but there may be another step in the analysis to determine, well, did we make an ECI election under 871D, or did we review the facts and circumstances and determine whether it was eligible to be treated as ECI based on facts and circumstances? And so that's kind of an interesting twist to foreign persons that have investment in US, because foreign persons are definitely eligible for 199A. I think you have to get through the regular mechanics of, do they have income that's effectively connected with a US trade or business?
Yeah, that's an interesting point, Aaron, that really it's a source, again, 199A is it's a sourcing concept. It's about having qualified business income. And you could be a US person that has QBI, you could certainly be a foreign person with QBI. And if you meet all the requirements, then you can claim the 20% deduction.
Right, and I think for a lot of maybe foreign persons that were doing structuring for inbound investments, I mean, typically when a foreign person is looking at acquiring some US asset, the recommendation is, well, let's do a model and let's figure out, not only from a US tax standpoint, which for us historically was fairly easy, now we have 199A to deal with, but then the other side of that was always the foreign jurisdiction. So whatever we line up in the US, that needs to work well for the foreign country. And so again, 199A is just another factor and another piece to that structuring puzzle.
So it brings us to our first polling question for CPE credit. True or false? We're making it difficult for the audience out there. A real estate enterprise is defined as an interest in real property held for the production of rents and may consist of an interest in multiple properties. And real estate enterprise is, I covered it quickly, but this is back to the safe harbor for rental income that we talked about 3 or 4 slides ago. So true or false? Excellent. So everyone was paying attention. True it is. So another important concept in 199A, this is particularly important for international considerations, given that ECI can be QBI, but non-effectively connected income is not QBI, is that the 199A deduction is computed on a trader business by trader business basis. And why is this important? Well, it's important because you could have a single entity, you could have a single partnership or a single corporation, S corporation, and it could have multiple trades or businesses underneath it. In each trader business, you would compute your 199A deduction at that trader business level. So what is a separate trader business, or how could you know if you have multiple trades or businesses, or how could you plan if you wanted to, maybe if you've had something you've treated as a single trader business, but you want to treat it as multiple trades or businesses, and we'll get into why you do that in a second, but how would you know? Well, the IRS says you look to there's existing guidance for having a separate method of accounting under Code Section 446, and we don't have to get technical with the code section, but the factors are, knowing that you have a separable trader business are there complete and separable books and records? And notice the word separable doesn't mean separate, it says separable, which would seem to say capable of being separated. Separate employees, geography, no doubt many other factors in play there too, to identify a separate trader business. And if you have something that's been treated as a single trader business now, how to break that apart into multiple trades or businesses. And why would you do that? Well, the reason why you do that is, as I said in the beginning, not all income is QBI. Non-ECI income is not QBI. There's also certain service income earned by lawyers or doctors or accountants or consulting revenue. That's also not generally QBI. And if you have a single trader business and you have more than the de minimis amount of what I'll call bad income, it taints the whole thing. And it's the so-called cliff effect, that you can come right up to the cliff, but you take one step and then you're at the bottom of the cliff. And if you have gross receipts over 25 million, 5% or more, if 5% or more of your gross revenue comes from a bad business, it taints everything. If you're under 25 million, your tolerance is up to 10%. So particularly in the international context, if you had a US trader business, let's just say 85 or 86% of your revenue is effectively connected income with a trader business, but let's just say you have the rest of it is non-ECI, and if your gross receipts are over 25 million, your whole business will not be eligible for the 199A deduction, even though 85% of your revenue comes from an otherwise qualifying business. So it's a very harsh result, this cliff effect. So the planning idea is, maybe you had one entity. In the example here, I have an S Corp, and maybe before it was more or less treated as one business, but maybe you isolate the non-ECI business, and in this case, this is on the left side of the slide, so that it frees up the ECI business number 1 and number 2, the 199A deduction. Because remember, 199A is ultimately a trader business by trader business determination. We have non-ECI income that can taint the good income. So what we're going to do is isolate that into its own entity on the left side. That won't generate 199A, but if you do it right, it can free up the 199A deduction for businesses number 1 and number 2. There's more. It's more complicated than I'm putting it out there, because there's some planning that you would need to do to make it clear that these are separate trades or businesses, and to make it clear that the bad business, the non-ECI business, doesn't taint the other business. But if this is an issue for you, that you have an entity and you have more than a de minimis amount of non-ECI revenue, this is one of the planning ideas for how to free up the 199A deduction, at least for the good businesses, the qualifying revenue. Also, quickly here, we won't spend too much time on this, but another nuts and bolts portion of 199A is that once you have your separate trades or businesses and you've determined that they're QBI, You can aggregate these trades or businesses together for purposes of the 199A deduction. Why would you do this? Well, it just makes it easier ultimately for compliance purposes when you're reporting all of this necessary information to the owners on the K1. If you can aggregate it together, it's just a much more efficient process to treat it as a single activity. There's rules here. We won't get too far into them today, but you can't just aggregate any business. There needs to be some amount of relatedness between the different businesses to aggregate them together. I think generally speaking, if eligible, it's something to consider because it makes it administratively easier to compute the 199A deduction. Then it also, I mentioned in the beginning that there's limitations to the 199A deduction, and the limit related to the W-2 wages paid and related to tax basis and property. Aggregating things together can potentially, you can share those limitation factors amongst different trades or businesses and potentially maximize the 199A deduction. So this is just a quick example here that you have a partnership, A, B, and C are partners in a partnership. If QBI, 3 different QBI businesses, and assuming that there's enough relatedness between the different businesses, PRS, the partnership, could aggregate those businesses together for purposes of 199A and report it as a single aggregated activity to ABC. If the partnership didn't do it, each individual partner could also choose to do it. So if the partnership did it, all of the partners would be bound by that. But if the partnership did not aggregate it, in other words, reported each of those QBI businesses as separate trades or businesses, A, B, and C on their own could make a choice to aggregate it. But important point, that last bullet point, specified service trades or businesses, again, those are lawyers or doctors. Non-qualifying businesses can't be aggregated, and also, so that would also mean that non-ECI businesses could not be aggregated with ECI businesses. So that brings us to polling question 2. True or false? There's a duty of consistency once an aggregation election is made, and a disclosure must be made on the relevant tax return. So I didn't, there was a bullet point on that. I didn't hammer that point home, but hopefully everyone read that bullet point and will know how to answer this as true or false. Excellent. So indeed true. And sorry, that was a bullet point in the slide before it, but I didn't actually cover it. But indeed, you need to be consistent once you make the election, and there is a disclosure that's required as well. So I mentioned in the beginning that not all business income is QBI. You know, one example is non-ECI, non-effective connected income, is not qualified income. The other example is what is called specified service trade or business income, or SSTB. And 199A tells us these businesses don't generate QBI, don't generally generate QBI. So this would be anyone involved in the services of health, law, so think lawyers, doctors, accountants, consultants, athletes, people involved in the financial service industry. All of these types of people, generally speaking, the income, even though it's a trade or business, the income from that trade or business is not considered QBI. Now, the big exception here would be that ultimately, if the owners of these entities have taxable income below a certain threshold, in fact, that income could be considered QBI. So the general rule is SSTB is not QBI, but if the owners who receive the K1 have taxable income under a certain amount, that income can be QBI. And you'll see the threshold amounts are actually pretty generous, that if you're a married taxpayer, it's $315,000 of taxable income. And if you're a single filer, it's $157,500 of taxable income. So we'll move away from this, but just the important point here is this is just another category of, it is a trade or business, but Congress in its infinite wisdom decided that these types of businesses, including people like myself, partners in an accounting firm, we cannot generally claim the 199A deduction. Crack and pack rules, this is an interesting, and this has an interesting international tax consideration here, but before the IRS issued the proposed regulations last fall, there was an idea out there that an SSTB, so let's just say it's a law firm or a doctor firm, or a doctor practice, could crack itself open, pull out the good assets that could generate QBI, pack those assets into another entity, and generate QBI from those component parts. So this would be the idea here. If you have a bunch of doctors that own their medical practice and that the building and there's admin services, maybe there's a trademark in that structure. The original structure, that's not going to generate QBI because they have too much bad income. But could they crack open that, pull out the building, pull out the admin services, pack them into new entities, and then generate QBI from those new entities? So the proposed solution would say that, can you generate QBI from the building, and can you generate QBI from the admin services? Not surprisingly, the IRS said, no, this doesn't work, that we're going to still treat that all as a single business if those businesses are all interrelated, meaning that they provide property or services to each other, and if there's common ownership. So back to that slide there, the building's used by the doctor practice, the admin services are used by the doctor practice, the doctors control all three, so that's all still a bad business, not generating QBI. Couple of interesting points that I'll layer in. One, it's an open question whether if you have a C corporation, it would appear that C corporations are outside of these rules. And then secondly, it appears that it's an anti-abuse rule, this crack and pack rule that the IRS came up with, but it appears that it only applies to service businesses, so lawyers, doctors, consultants, accountants, and so forth. And it does not appear to affect businesses that have effectively connected income or non-effectively connected income. So could a business with good ECI, it would appear that it can crack itself open and pull out the good stuff and pack it into another entity to generate 199A eligible income, ECI income. So it's interesting that they didn't, the abuse the IRS anticipated was really on the domestic front, lawyers and doctors and so forth, and didn't seem to apply this anti-abuse rule to businesses with a mix of effectively connected income or non-effectively connected income. Brings us to our third polling question. The term SSTB refers to what? A business that always generates QBI, a manufacturing business, a specified service trader business, or all of the above?
Adam, I just want to mention that crack and pack idea is fairly interesting. I think we'll see that in the next few slides when we look at some structuring and how 199A affects it. But I mean, really the concept is, can you separate two different trades or businesses? And from an international standpoint, can you separate them because they're in different jurisdictions? And it seemed like, well, that would be fairly easy to do. But you still have to look at those anti-abuse rules, especially it seems like if you have specified services.
Yeah, agreed 100%. SSTB is a specified service trader business that generally doesn't generate QBI unless you're under the taxable income thresholds. Some quick compliance considerations, and then I'm going to turn this over to Aaron, take us home. But an RPE is a relevant pass-through entity, and that's a new term under the 199A regulations. Basically, it's a partnership or an S corporation. But if you have 199A, if you have QBI income, you have to put all of the necessary information on the K1. So the first thing you'd have to do is indicate whether the income on the K1 is QBI or not QBI. But then you'd also have to include the owner's share of W-2 wages paid by the business, the basis of qualified property. We didn't go into this. UBIA is the unadjusted basis of property immediately before acquisition. Basically, cost basis and qualified property. It's one of the limiting factors for 199A purposes. But big takeaway point, you need to put all of this information on the K1. If you don't do it, the IRS says it's presumed to be that those items are presumed to be zero, which would effectively could result in the owners having no 199A deduction. And then finally, also consider there's heightened penalties if people are playing games under 199A. There's heightened penalties that the IRS 20% penalty kicks in at a much lower threshold than it previously did. And there's a new audit regime for partnerships that makes it much easier for the IRS to audit partnerships. So those two things together just, you want to be careful with 199A. It's going to be a lot easier for the IRS to assert a penalty, particularly if you're a partnership. The IRS can find an adjustment that a 20% penalty could apply at a much lower threshold. I'll move through these quickly. 754 adjustments are if you buy into a partnership and a partnership has a 754 adjustment, the purchasing partner is allowed to adjust the basis of the partnership property and get additional depreciation for that. That adjustment can go into the UBIA, which is, again, one of those limiting factors for 199A. So that's a bonus. If you buy into a partnership, your 754 adjustment can help you for 199A. If you're using property or using the cost basis of property as part of 199A, and it's going into your limitations test, you have to hold that property in the last day of the taxable year in order for that property to go into it. So if you sell it December 15th, you're deemed to have no cost basis in property for 199A purposes. So the incentive would be that if you have property and you're dependent on the cost basis of that property to maximize your 199A deduction, you may want to wait until the following year to sell it. And that's contrasted with W-2 wages, which are another one of the limiting factors that you can apportion those. There's no end of the year test, that if you sell halfway through the year, you can include half a year's worth of wages. So it brings us to our fourth polling question: true or false? Property must be held in the last day of the taxable year in order for taxpayers to use UBIA, which is the cost basis in the property. And indeed, true it is. Have to hold it in the last day of the year for it to count for 199A purposes. All right, Aaron, I'll turn it over to you.
Yeah, awesome. So have a few more slides remaining in the presentation, mainly focused on some selected international tax considerations. One of them being income sourcing. How does that affect 199A? And then also, just from a structuring standpoint, when U.S. trades or businesses, or U.S. taxpayers are considering expanding abroad, what are some of the 199A factors that have went into that analysis of how to best structure that, that foreign activity? And so with income sourcing, we've had in existence rules for how to source income, and it mattered for international tax considerations for a variety of reasons, mainly foreign tax credits. And if a U.S. taxpayer would typically want to increase their foreign source income to maximize their foreign tax credit. And so the existing rules are there, and the ECI rules have been in existence also for international type taxpayers. And I think one way to look at it when you're thinking about 199A and you're thinking about these sourcing rules is going back and thinking through, well, how did they originally apply, or who did they originally apply to? And if you think of, well, if you had, for instance, a French company, and that French company was selling widgets, and it was doing well in Europe, and it thought, well, I want to expand in the US, the question would be, well, at what point in time does the US start taxing the income that's generated from those widgets? And typically, from a US tax standpoint, that French company would need to have a US trade or business, and then it would have to have income that's effectively connected to that US trade or business. And as we're going to see on the next slide, that effectively connected consideration usually applied to when that income was considered US source. Because if you had a French company, in my example, and it had a US branch, and it was selling products within the US, well, typically you would say, well, that's US source income, and that's attributable to my US branch, so that should be subject to US taxation. But on the other hand, if that French company is selling the same widgets to Canada, at what point does the US say, well, that income actually belongs to your US branch because the income's effectively connected to your US trade or business, even though under some sourcing rules, it would be considered foreign. And so one place to start, and I think this table summarizes it fairly efficiently, is with publication 519. And you'll see this table that's straight from it, and it shows in general how income is sourced. And I think for purposes of 199A, you probably focus maybe here on inventory. Inventory, at least under tax reform now, inventory is sourced one of two ways. If it's manufactured inventory or purchased or produced inventory, I should say, by the taxpayer, then you would source that inventory to where it was produced 100%. So for instance, if you had a US taxpayer that manufactured a product and it sold it outside of the US to a customer outside the US, the factor that was the main consideration was where was it produced? And if it was produced from the US, then it's considered US source income. The rule is different if the taxpayer has purchased inventory. In that case, it's sourced to where title passes. So if you had a US taxpayer that's purchasing inventory, maybe a distributor, and then selling it outside the US, you would look to where title passes. And that would dictate whether the income is foreign source or US source. And as I mentioned in my example for a French company selling widgets and sets up a US branch, the US, I think fair to say in a gross oversimplification of the rule, would say, well, if you had a US trade or business, then typically the only income that's going to be subject to US taxation is income that's effectively connected with that US trade or business. And so the question is, well, what type of income would be effectively connected with the US trade or business? And there you would look to code section 864. And 864 generally says, well, if you have US source income, and again, this is a gross oversimplification of the rule, but if you had US source income, then typically that's going to be considered effectively connected with your US trade or business. However, that's not really the end of the story because there are exceptions. And of course, it matters for 199A because if you have a US trade or business, and if the only income that's considered effectively connected is US source income, then that would mean all of your sales to foreign customers that are considered foreign source, that none of that would qualify. And so one of the, I think, the helpful exceptions is listed under 864C4B, and I'll just point you to, it's the third bullet on the screen, and look at the third bullet of the third bullet, I guess. And that says that if you have a US trade or business, and even though the income would be considered foreign source, it would still be considered effectively connected income if the sale is through that US trade or business. So jumping back to my French example, where maybe the general rule is if that French company sold product to Canadian customers, and if that's considered foreign source, then generally that would not be considered effectively connected with US trade or business. But on the other hand, if that French company's US branch, if it made the initial connection with the customers, it customized the product or the design of the product for those customers, maybe it is involved in some light manufacturing or some assembly, then even though that sale might technically, under the sourcing rules, be considered foreign source, I think you still can attribute it to your US trade or business and consider it effectively connected with your US trade or business. And so what that all really boils down to is that income that is attributable to our US trade or business, just because it's foreign source, I don't think that's the end of the story. It means that it's not included in QBI. I think you still look to see whether it's effectively connected with that US trade or business, and you could still look at some of these code sections that provide examples or exceptions to get you to effectively connected. I have a few minutes left and would like to focus on some structuring issues that have come up with 199A. And this came up right away. When 199A came out, of course it came out with tax reform. And with tax reform, there were quite a few rules related to international tax, particularly related to structuring. And that's going to be evident on the next slide. And so we're helping quite a few clients determine, okay, you had this old structure that worked really well for tax purposes, and it got you to your lowest global tax rate. But now with tax reform, because of some other rules, mainly those with international tax, now you're not getting a very good answer. So maybe it's time to relook or rethink that structure. And the question would come up, well, what happens with 199A? And I want to show it just in this context. This is a numerical example, and on the left-hand side, you have US operations, and on the right-hand side, you have foreign operations. Sometimes a taxpayer considers, well, should I move my operations outside the US? for viable business reasons. Maybe 90% of their customers are outside the US. Maybe it just gives them a better footprint for where their product is going and where that's going to fit in the marketplace in 3-5 years down the road. And so you can see in this case, if the income is effectively connected with a US trader business, on the left-hand side, that should be eligible for 199A, and assuming no limitations apply, they get down to the 29.6 rate. On the other hand, if they took that same business and they shifted it outside of the US, and they still had the same flow through, they're down to 37% because it would not be beneficial. They would not get the 199A consideration, or deduction, I should say. And so even though it may be more expensive to keep business in the US, or that trader business in the US, from a 199A, I should say, just from a tax perspective, maybe some of those tax savings eat up some of those additional costs. Another thing we commonly saw was the decision that, let's say you already have a foreign activity, and that foreign activity is being operated on the left through a foreign corporation. Typically, we were seeing that that was producing a high tax rate for individuals who own that foreign corporation, either directly or through a US flow through. And you can see in this example, it was down to around 53% of tax. And the question, or the option, was, well, if you were operating that business through a foreign corporation, maybe there's an opportunity either to reorganize so you could operate it through a disregarded entity in the foreign jurisdiction, or you can make a check the box selection and just, for US tax purposes only, treat that foreign activity or that foreign entity as if it was a flow through. And you can see here, the benefit really comes down to foreign taxes and the elimination of double tax. On the right-hand side, 100% of the taxes that were paid in the foreign jurisdiction were eligible for a foreign tax credit. And so the question came up with 199A, well, if I have a US S Corp or partnership and it owns 100% of my foreign entity, and now I switch from a corporation to a flow through, how does that affect my 199A? And there were several considerations. As Adam mentioned earlier, there was this thought of, well, I have my good US trader business that's eligible for 199A, and now what happens if I check the box on my foreign entity and all the income flows through to my US trader business? Does that somehow taint my trader business, my good trader business here in the US? And I think the answer there is fairly clear. I think as long as you have separate trades or businesses, you can keep them separate. And you could still have your good US trader business qualifying for 199A. Of course, you would want to watch out for services and whether there's a service taint. Another consideration was, well, if you had a foreign flow through and that foreign flow through was producing losses, typically that was beneficial, of course, from a US tax perspective. But does that somehow reduce my 199A deduction? And I guess the question really is, are those losses as valuable as before? Because instead of maybe offsetting 37%, tax, that's only offsetting 29.6%. And so that could also impact 199A. The other idea is if there was losses that were flowing through and you did have a flow through, and so you had a flow through, losses were flowing through, or maybe you had tainted income in that flow through, the other idea would be to treat that foreign entity as a corporation. And so the income's not now coming back to the US and not mixing with my good 199A income and reducing my benefit. Last numerical example that I want to go through is related to FDII deduction and 199A. If you're not familiar with FDII, I should say, that allows a USC corporation a 37.5% deduction on qualifying income. You can think of it kind of as export income, also applies to services, rents, and intangibles. And so the key with that deduction is, one, you have to have a USC corporation, and of course you have to go through the mechanics. And so one thought is, well, if I have income that qualifies for 199A and it qualifies for FDII, which produces the best result? And you can see in this simplified calculation that on the left-hand side, FDII gets us to 37.8%. On the right-hand side, we get to 29.6%. And so could still be favorable just to have that flow through. Of course, in this example, there's a key consideration that's omitted, and that's state tax. And that could significantly change the answer, especially if that state tax has favorable rates for dividends or sale of stock. Lastly, just want to mention a couple other things related to 199A and how it affects or combines with international items. And I'll just point out the second one, and that's really with the IC-DIS structure. So again, if you're not familiar with that, in a flow-through structure, so if you had a US S Corp or partnership, that flow-through typically, if you were exporting from that flow-through, you could set up a DIS structure where you would pay a commission from the flow-through to a USC corporation that was exempt for US tax. And so you would get a deduction on the flow-through side of ordinary rates, and then you'd pick up the income as qualified dividend income. And before, that difference was 39.6 as an ordinary deduction, then you're picking up the income at qualified rates, maybe 23.8 when you add in net investment tax. Well, now with 199A, that spread is quite a bit less. And with 199A, you might be down to 29.6%. And with a qualified dividend, again, you still might be at that 23.8%. So the IC-DIS structure still may be beneficial. It just kind of tightened the belt a little bit and causes us to take a second look at it and see whether that benefit is still there. And I think with that, Amy, I'm turning it over to you for July webinars.
Awesome. Here is a list of all of our upcoming July webinars. If you'd like to join us, please visit our website and you can register. Just as a reminder, if you're looking for CPE credit, we will email out those certificates within 10 to 14 days after this session once we gather all the data. If you do have any questions, we did run out of time, so feel free to reach out to Adam or Aaron directly, and they can answer your questions, or we can leave it open for just a few minutes if anyone wants to submit anything.
Excellent, thank you. I mean, thank you everyone for attending. Please again, reach out with any questions, send an email to myself or to Aaron.
Yeah, absolutely.
Awesome. Thank you all. Everyone have a great day.
Thanks.
Thanks.